The following podcast was recorded on Thursday, January 21st, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome to the latest edition of Talking Data. Our Talking Data series seeks to offer timely insights into the macro market themes along with macro data and its impact on the economy and markets. I am your host, Kristen Radosh of Arbor Research and Trading. Our presenters today are Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Today we will discuss Janet Yellen's testimony, what to expect with stimulus and COVID relief, and we will end with Robinhood Investors. Jim, we're going to get started with you today. Janet Yellen testified earlier this week. What are the key takeaways, and are we looking at a 50-year maturity?
Well, let me start with that one right away. She floated the idea that the Treasury would consider a 50-year maturity. This after less than a year ago, Steve Mnuchin, the now former Treasury Secretary, also floated the idea of a 50 or 100-year bond. And that goes after Jacob Lew 4 years ago floated the idea of a 50 or 100-year bond. This is not new. This comes up over and over again, whether or not the the Treasury should increase their maturity. Now, just so everybody knows where I'm coming from, if you anoint me ruler of the planet, I would argue Ben would be very afraid if you did, for one. But second of all, I would say that the new yield curve of the Treasury would be 30, 50, 100 in perpetuals. I am a big fan of extending way out there right now. But the dealer community and the Treasury Borrowing Auction Committee, which is the TBAC, which is their voice within the Treasury to talk about making these kind of changes, is dead set against any kind of long-term maturities. This is what kills it every single time. And the reason the dealer community is dead set against it is the dealer community is afraid that if the demand for a century bond, a 100-year bond, or a 50-year bond is not there, they're stuck with these bonds. They're stuck making markets in unprofitable securities. So they're not a big fan of it. The Treasury Department is not ready to abandon the dealer community and go to like a platform that a market access or web or trade web would offer. And they're not ready to push back on the dealer community and say, we hear you don't like it, too bad, we're going to do it anyway. So I suspect this is going to be more the same. A lot of blather. They should do it, but at the end of the day, if the dealer community continues with its insistence that they don't, it won't really happen. Mnuchin had to compromise to save face with a 20-year bond. I don't know if Yellen's going to come up with an 18-year bond or a 25-year bond or something like that, or maybe a 7-year or something in the middle, or a 4-year, bring back that one. But it's going to be very, very difficult for them to bring it back, although I do think it would be nice if they did.
Yeah, a lot of this, there's a lot that goes into this decision. I know, Jim, you're not going to agree with much of what I'm about to say here right now, but I thought Joe Weisenthal had some good comments that are definitely more MMT focused, with the idea that we can't really necessarily treat the government, the U.S. government, like a household, that we have to always issue bonds necessarily to pay for infrastructure or whatever we're spending on and so on. In the end, all we need is a House or Senate vote to do so. So the concept of adding more duration and further out the curve could end up being kind of counter to the QE and the purchases and the shortening of duration that QE is meant to do. It could kind of be a battle in that regard. Also, there's a question whether or not the demand will be there. Yes, pension funds, some insurance companies obviously might, it might fit, and maybe that's something that the government should do to try to fulfill that demand, fulfill that service, that need. But even the 20-year is been kind of a question mark. I think the 20-year right now is cheapening on the curve. That's the new point. They've issued 20 years. The government's buying them to a certain extent, but now dampened. I think they own typically are the percent outstanding. They own somewhere around 60, 62% of them. That's diminishing. That's allowing that point in the curve to cheapen relative to 10s and 30s. So I'm curious to see how that ultimately kind of goes, that being the orphaned area of the curve. So yeah, a lot of question marks. It sounds great. You can lock in low interest rates, but I think there's kind of a sea change happening here with how all of us and the government's going to view Treasury debt for the most part. I don't think it's going to happen overnight, but I think treating it like a household might become somewhat of a thing of the past at some point.
That's an interesting comment. Yeah, I can understand, Weisenthal, your comments or where you're coming along with that. I'll just conclude this section with one quick comment. If you are thinking about the United States as an asset and you're trying to duration match it, what's its duration of the United States? Well, we hope it's forever. And if it's not forever, nothing else matters. And so we might as well extend out the maturities as long as we can to kind of liability match the asset as well too. Because right now we've got this very long tail asset, a 250-year-old country that we keep financing with overnight money. And so that there is that kind of a mismatch that we've been running for a long time as well too. But I understand the other arguments as well. We'll just have to see, what it is that the Treasury wants. And I'll just conclude with just emphasizing something I said before. Right now, it seems like, which I very don't like, is the Treasury proposes, the dealers say no, and it's like the Treasury says, well, okay, I'm sorry I brought it up, we won't do it. Who's in charge here, Janet? Are you in charge here, or are the dealers in charge here? And so that's kind of the bigger issue they got to decide.
Ben, we're going to move over to you to start off our next topic. Should we expect, what should we expect with continued stimulus and COVID relief?
So yeah, I'm not necessarily a soothsayer in that department, but with Yellen claiming that we need to essentially go big, I think that obviously the concept of this $2 trillion stimulus package has some legs, and is something that is, of course, risk on for markets in general, and is likely warranted. We still have 3.4 million people that are permanent job losers. And as Jim has also been rightly talking about, we have 9 million that are still, unemployed in terms of filling that gap from where we were pre-pandemic. So I think that the opportunity here, given the blue wave and the ability to have the votes, mean the stimulus will be coming. Like Jim's always said, the big question mark is, well, two things. One, what is that ultimately going to do with spending and with inflation on the back end? That's a huge consideration. And then two, with savings rates are already so high and the vaccine on the horizon, or really, being put into place now, is there the possibility that that could be, too much, and maybe even too at some point if things correct very quickly on the COVID front, maybe even some of the legislators get a little bit less likely or willing to do that. That's kind of the question. But I think there's a high probability we get a bigger package, especially when you have Yellen and most obviously Congress and the Senate controlled by Democrats willing to make that leap.
I think that as far as the deal goes, where you might find the sticking point is, all right, should we mail checks to people? Everybody's going to say yes. Should we extend unemployment? Everybody's going to say yes. Extend eviction moratoriums, bail out the states. Yes, 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 yes. Then when you get down to okay, here's a bunch of corporate welfare, to call it what it is, a bunch of handouts to individual companies or individual industries, then I think you're going to start to see some pushback within the Democratic Party. And that's where the fighting is going to come. And that's where it's going to be kind of interesting to see if enough of that comes into the bill to poison it. And that's where it might come down. Now, on the Republican side, I think the Republicans are going to be dead set against the aid to states. That they're going to see that as a bailout of bad behavior of states. And since Ben and I are both in the state of Illinois, we know nothing whatsoever about bad behavior of state at all. And that's going to be a big pushback as well too. But in the end, I do think that there's going to be a sizable bill. Those are just kind of the contours that they're going to have to work out. And if nothing else, just to emphasize something that Ben was saying, if getting these contours worked out pushes your bill out to April or May, and then you wind up having, say, tens of millions of people vaccinated by that point, maybe the infection count has been peaked and it's starting back down, the economy's picking back up, the cold feet could then unfold a lot more later on because, man, look at this economy's getting better. Do we really need to do this? And does it create an inflation problem or some other issue down the road? But if you're pushing it out the door in February, I don't think that's going to be as big an issue. So we'll have to see how this one unfolds.
And next, let's end today by talking about those Robinhood investors that we've spoken a lot in the past about them. When they do receive this stimulus money, where do you think they're going to put that? Where will they be investing? Ben, do you want to start us? Oh, Jim?
Yeah, I'll start with that one. They're going to buy the Goldman Sachs non-profitable stock market is what they're going to buy. I think, let me just say one quick thing about the Robinhood investors. By the way, that Goldman Sachs Tech Index, I tweeted it out the other day, and it was just a stock index that I came across that I thought was interesting, and it's gone viral in the last couple of days. But I will say what has happened, and I think people need to understand this, is that there's been somewhat of a sea change since the spring. Prior to the spring for 10 years, we all understand investors were shying away from the vehicles of active managers, no longer interested in the active managed open-ended mutual fund. They preferred ETFs tied to indices. They still do. But what we're starting to see since the spring is now they're starting to take it upon themselves in order to start investing their own money. I think the two big drivers of that are, one, the cut to zero commissions and fractional shares that we had in late 19 and early 2020, that has opened it up or has perceived to open it up for investors. I know a lot of Wall Streeters will say, well, it's not free. They sell the order to some big firm like Citadel, and then they get filled at the offer at a bad price. No, the public doesn't care about that. They just see no commission. And that's as far as they do. And then fractional shares. Well, I really can't pay $1,700 to buy Tesla, but now you can buy a tenth of it for $170. And so that's pushing them in there. In addition, the stimulus checks, I think, have really helped that along. Yes, they got the original CARES Act money, and they've gotten some other money, and the economy was so dicey. Well, I'm not going to go out and buy a new car with this money. I'm not going to remodel my kitchen yet, but I'll save it, and a form of savings is a brokerage account. And they've been chasing, the stocks that they like in brokerage accounts. Now, I suspect we'll continue to see that happen as we move forward from here, especially if we get more stimulus quicker. I think it goes towards investments. And then eventually when we start getting towards the talk of herd immunity, reopening the economy, when Ben and I can go to a Wrigley Field for a Cubs game again, then they'll say, okay, things are getting better. Now maybe I could take that money and actually buy that new car or remodel my kitchen or anything like that. Ben, what's your thoughts?
I think the fractional thing, share thing was big. I mean, you talked about that immediately as it happened, and I think that allowed a lot of these companies to exist. I mean, you watch commercials now on whatever Hulu or Netflix, and you see new companies that are there to compete with Robinhood. So this is gone beyond fad status at this point. And I think the retail community, like you said, is focused so much now not on just buying ETFs, but buying on specific individual equities, and they like these high-flying momentum stocks that are also attached to the new economy. So part of this is, yes, it's exuberance and wild speculation, but it's also this transfer due to the pandemic from kind of the old economy to the new economy, technology, be it Plug, Teslas, Roku, whatever it may be. Companies that will likely be here for some time, not all of them, but for some time. And what I've noticed is that we can track a lot of this small trader retailness via their search activity, which is really interesting. And you saw this just explosion in desire to learn about day trading, swing trading, and so on. And what we've also seen is an ability to essentially time the market to a certain extent based on their desire to either be long or short. Are they bullish or bearish? Are they buying bull spreads? Are they looking at iron butterflies, for vol consolidation and so on? And if you kind of look at all these different topics that they're searching on, what's interesting, create these spreads, what things that they're optimistic on and then pessimistic, and look at the difference. And really, you can see this exuberance has been really firm since early May and is not backed off yet. I think until we see that kind of fervent search activity for being long, swing trading, day trading, call options, and so on, get replaced by fears of market corrections, recession talk again, or just being short in general, this probably has some time to run. And I think it's a great indicator, and it creates a new world for all of us. When we maybe laughed at this, Jim, we used to have these discussions months ago, and a lot of us, even within the organization, be like, what are you talking about? This retail money is really swinging the market one way or the other. And I think that there's some truth to that to a certain extent. And so now there's a whole set of indicators for us to burrow into, which is, I think, a lot of fun.
I agree. It is a lot of fun. I'll leave this with one other thought. There's a very famous tech investor, Roger McNamee of Elevation Partners. He was Bono's partner in investing. And Roger's kind of, one of these guys that kind of speaks without a filter, so it makes him very interesting. And whenever people ask him, Roger, what do you like? What should people be buying? He will point out that 90% of the investments that he's ever invested in have gone to zero. But in the world of tech unicorns, I could whiff on 9 or 10 of my companies and they can go to zero. But boy, if that 10th is a unicorn, I'm really rich. And so that's the way that that mentality where people buying all these companies are, they don't care if 80% of them go to zero because it only takes one unicorn. And there's been so many examples of unicorns, whether it's Snap or Facebook or whatever you want to take as your example, that they're willing to continue to push for that one, 100 bagger that's going to make up for not only every loss that I've had, but leave me much, much better off in the long run. That mentality is going to be around for a while. It's going to take a time for that to break anytime soon.
Well, thank you, Jim and Ben, for your thoughts today. We really appreciate it. Also, thank you to our audience for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent research offerings are Bianco Research and Arbor Data Science. For further information, please contact Gus Handler at gus.handler@arborresearch.com.